Hello, welcome to the Behavioral Finance Dialogues on Corona Crisis video series. My name is Gulnur Muradoglu. I'm a professor of finance and director of the Behavioral Finance Working Group. I work for the School of Business and Management at Queen Mary University of London. Today, I will be speaking with my colleague, Dr. Jerome Booth of New Sparta. We will discuss global investments during the Corona crisis. If you enjoyed this video, please share it and subscribe to the Queen Mary University of London YouTube channel. And please come back and listen to the other talks in the other series. Okay. Thank you for coming. So I'm going to ask you about global investments during the Corona crisis. It's a big crisis. The last time the GDP was down this much was about 300 years ago. And GDP is falling almost everywhere in the world. Some sectors are shut down almost everywhere in the world. So what do you say about global investments in this environment?
Well, we have had a series of financial crises ever since the end of Bretton Woods, of course. And we've got a number of global imbalances which haven't gone away. In fact, I wrote about them in my book, which was, 7 or 8 years ago. And what we've had since then is a further build-up of credit in the system, which is characteristic. You're talking about 300 years ago. It's characteristic of booms. They're preceded by a huge build-up of credit in the system. And to put that another way, there's a lot of money looking for investments, and they don't know where to put the money. And what they have always tended to do is to, first of all, go back to the, if you like, the financial center of the world, which often is the cause of the blow up in the first place. But then the money, bizarrely, goes straight back. And nevertheless, there are periods of history, of course, where that primacy then shifts. And so I can talk a little bit about that. I think the global environment is very important. A couple of things I would say first, though, is about general perceptions about the crisis. There's a lot of uncertainty, and it is unprecedented, so we don't actually know what's going to happen. One of the key things about, if we're just looking at a domestic economy, and then we'll get on to the international, one of the key things to understand is that there's been a big hit to aggregate demand. Consumer demand has sunk as people are in lockdown, they're not spending money.
And this is different from the 2008 crisis, isn't it?
Yes.
This was not triggered by the financial sector, but this is a demand-side crisis, really.
It is. Having said that, doesn't mean it can't lead on to other financial aspects as well, which is what we need to watch out for. Because, of course, the leverage in the system is even more than it was 10 years ago. It's just in different places. But sticking with the aggregate demand issue, first of all, there are a lot of people who are really don't know what's going to happen, and they're very worried about people just not spending as much. I don't know, but one of the sort of laws of economics, insofar as there's any laws at all, but one of the empirical observations, but we're in new times, so we don't know whether it's going to be true, is that the consumption function tends to be very, very fixed. My hunch is that won't change a huge amount. In other words, that we will see consumers come back, and the incomes they have, they will spend. Having said that, their incomes might initially be slightly less. But I am, so what I'm really talking about is the difference in a V or a U-shaped recovery. I rather suspect it'll be more V than U, for the simple reason that people will still spend money. We are not quite sure what they're going to spend the money on. And of course, the investor's job is partly to work out what they are going to spend the money on, which is new. The easier thing is kind of what they're not going to spend so much money on. Having said that, there's also, lots of potential here for people to, get the doom and gloom books out and think this is, restricted global resources problem and globalization is over. I think we have to take a lot of that with a pinch of salt.
But you don't think globalization is over?
Globalization? No, I mean, I think for 85% of the world's population, they haven't had enough of it yet. And I think we have to get over the ethnocentric view of the world, what I call the core periphery view of the world. We have to start realizing that there's a whole 85% of the global population that doesn't live in Europe and North America and Japan. And actually, it's what they think and what they're going to do that's going to matter. There will continue to be a global market for lots of commodities and industrial products if countries in the West decide not to participate so much and be a bit more protectionist. I don't see any reason why that should flow into other countries. I think that's a nonsense, because most people would like more globalization, not less. So I think there'll be politics around that in the West, as there already have been, and that will be accelerated. I think there is a trend generally to speed things up. So there are, first of all, I think consumption will come back. We're not quite sure what. So it's the job of investors to think about, home entertainment or all the other business-related investments that are going to allow people to work from home or travel less or whatever. What we're also seeing is effectively a bunch of structural shifts all happening rather quickly. A lot of allocation and reallocation of resources, which actually has, if you like, kick-started allocative efficiency, if we're going to talk like economists. Allocative efficiency arguably has just got a really big boost, and hopefully this will lead to a significantly increased productivity in a number of, if you like, new growth sectors. And again, we should be looking at that. I think the role of a government is going to be particularly important. So whilst there are some governments that still, if you like, are still wedded to old rules of thumb, fiscal rules in particular, it's really important to realize that we do have a major aggregate demand deficiency, and we therefore need to fill that gap. And this is obvious case for substantial government expenditure. And for that to be focused, as it's so often not focused, it's very interesting. The IMF was issuing some studies before the financial crisis about how generally, the multiplier on public investment is below 1, in some cases even negative, very, very poorly done. And then, of course, when the case needed to be made about, after 08, there were some other studies which looked at multipliers, but they were a bit of a cheat, some of them, because they were looking at the effect of withdrawing investment rather than putting new amounts in.
Also, this time, the cash injection is made through the wages and to the real side of the economy, not through the financial sector.
So far.
So far, yeah, true, so far. Yeah. So do you think that this will be a more effective way of inducing demand?
I think if we stick to, say, the UK, where and much of Europe, where there's been furloughing, jobs have been preserved, that's much more likely to lead to a quick recovery than in the US, where they've actually pumped in much more money, but many more people have been redundant. And I think this lets if you like, companies off the hook a bit more. They're more likely to go back to capital investment, arguably. And the history of what's happened to relative use of factors of production is very relevant here, because we've been in a period of prolonged uncertainty. I'm particularly talking about the United States here. The reaction of firms has been not to invest in new capital, but rather to hire workers. And that is one of the reasons why you've had this complete fall off in productivity. Because what's happened is they've hired workers in the knowledge that they can always get rid of them very quickly if need be. And so now we have a crisis. What happens? They get rid of all the workers quickly. They haven't, through the last 10 years, really been investing in capital equipment, and that's now going to show. So I think there's a serious problem for countries which in the developed world, which have been facing many years of uncertainty about their if you like, the level of investment. So this is an additional reason why government expenditure is really important. But the quality of what is done is very important. So I think we've talked a little about the labour market. I'm going to leave that to others to comment, because I don't have a huge criticism of what's been happening, particularly in Europe. Where I think we need to think further is about how we can make fiscal expansion credible to bond market investors, there will be a lot of people who are very worried that if we have a huge expansion in indebtedness, even if it is in our own currency, that at some point maybe gilts or treasuries won't be bought up by investors, foreign investors as well as domestic ones. And I think one of the keys is to signal very clearly that there are lots of automatic stabilizers. So there's the obvious ones. I mean, there's the ones we've just mentioned in the labour market. There's lots of other ways in which we can do it through entitlements or just giving people money, to be quite honest. But there are some more subtle ways of doing it. And in particular, I think in the credit and monetary arena, we've been in an environment now for a long period where central banks have lost more and more control over the money supply, because most of the money supply is created in banks, which themselves, are subject to tacit knowledge. They're not observable even by their own management, frankly, and they have been obviously out of control, and they therefore have created credit booms. And Lord King, in his previous book, The End of Alchemy, recommends we actually use this opportunity, this period of massive QE, extend it actually further, and use it to disintermediate banks. And so this could take the form of the central bank taking in deposits, and probably in a new cryptocurrency. By the way, they would at the same time ban all other cryptocurrencies, just as countries, nation states, have the monopoly legitimate use of violence in a society, so central banks have the monopoly legitimate issuance of currency. And it's been very convenient for central banks around the world to allow these monetary emissions through cryptocurrencies for a while. But at some point, it'll just be banned. It would be a criminal offence. People would be put in prison. And that's started to happen in certain countries already. But that can be very sudden. But if the central bank has a cryptocurrency, it will enable them to take deposits, over time gradually take them away from the banking system, insist that the bankings have effectively no gearing or very little gearing, by insisting that they buy assets at the central bank, and then change their reserve requirements. In the very short term, even if we don't go down that route, a good automatic stabilizer when you've got excess credit like this is to regulate the reserve requirements or the amount of credit. One of the problems, and this also affects the discussion at the moment, particularly in the States, over negative interest rates, is negative interest rates are being objected to by the Fed on the ground that it will hit the profitability of banks, and that will have a problem in terms of credit generation in the economy. Well, in certain economies not too far from where we're sitting, that's kind of academic, because the banks are not providing credit into the economy in the first place. They're still nursing their wound because they haven't been recapitalized since 10 years ago. So it's kind of academic over there. There may be, in parts of Europe, a more radical approach, maybe involving a central bank disintermediating banks, might make some sense. I think the other stabilizers are important, because they can affect incentives now about, if they're automatic, the degree to which you can adjust very quickly. And the IMF, of course, is recommending this in a general way at the moment anyway, as they would, to all countries, but specifically just on fiscal policy in general, without going into specifics. I'm thinking more, I'm agreeing with that, but I'm also saying we should do quite a lot of those automatic stabilization mechanisms within monetary arena as well.
Are you concerned? Sorry, are you concerned about inflation following this period of liquidations? Yes. I mean, although it's not through, it's more direct than coming through the banking system, but still, are you concerned about it?
I'm very concerned, and I think there's obviously a lot of discussion about this. But if I was to, and the basic arguments are, yes, we've got demand deficiency now, but demand may come back very suddenly. In fact, they might, because there are bottlenecks, it might really overshoot for a bit, and that might change expectations, suddenly got inflation. More worrying is the international aspect, where you've got much more vulnerable economies which might collapse And obviously the German Constitutional Court ruling last week is hugely important if it causes major disruption in the Eurozone. And there's a key aspect to that, by the way, which people haven't picked up on yet, which is that, I'm digressing now, but they're talking even today now about the Commission issuing a bond. In other words, in order to get away from the German courts, the idea is not to have joint and several liability of the sovereign nations in an issuance. Well, that is really a very bad idea. It's a very bad idea because it creates a market in expectations of how long the Eurozone, or for that matter, the EU, is going to exist. And it creates an incentive for countries to leave the Eurozone, because if that issuance gets large enough, the moment you leave, you're not obliged to repay it. The fact that they're talking about a perpetual bond is even more ridiculous, because it may on the surface appear that if you issue a perpetual bond, it's okay, you don't have to pay it back. But a perpetual bond is effectively creating a market in how long you think the EU is going to exist for. That's what it creates. So it's actually creating a mechanism which can massively overshoot because expectations overshoot. It gives, if credit spreads widen, it actually gives countries an incentive to leave the Eurozone and to do so in a cascade system. So there's the thought over there about what to do about the lack of joint and several liability, the lack of ability to actually issue jointly guaranteed bonds or instruments to use fiscal policy, means that Europe is at a huge risk of not coping with the need for massive fiscal expansion. And of all regions, it's also the most vulnerable in terms of the financial sector, the banking sector. And so I expect sparks. Now, when you get either a crisis from overseas where there's inflation, or you get a sudden lift up in demand because of domestic dynamics, and the behavior of consumers here are absolutely paramount, you will potentially have a big, very fast shift to inflation from deflation, which is currently the fear. And what a lot of people the other main thing people don't get is how fast you can go from a deflation environment to an inflationary environment. It's not something that might take months. It could be extremely fast, especially given a very large amount of sovereign debt involved. Because the moment you have a very big, if you like, a prompt to it, you would expect the bond market to basically steepen massively, because initially people are expecting over the long term for interest to go up massively. And where expectations are ridiculous. There's no perpetuity in low inflation in the world. That's a function of the extraordinarily unusual period of QE, which has to end at some time anyway, because it's creating oligopolies. It's destroying competitiveness in our economies, and it is actually creating inefficient investment, reducing productivity. So the crisis, the coronavirus crisis, interesting, is a spur to sort of, if you like, get ourselves out of some of this rut if we have the right policies. And that means probably doing something quite radical with monetary policy. Actually, I would back Lord King's idea of gradually, not all at once, we don't want banks to fail on our doorstep, but signal that over the next 15 years or something, we are gradually going to disintermediate banks. And we are going to, in the short term, give, through central bank being more involved in credit creation directly, actually give them the tool set that they need to have some stabilizers on the economy. That's one. Have some other stabilizers in there, fiscal ones, and do some interesting things which are fiscally neutral. So I'm a big fan of repealing 1961 housing legislation, such that some of the uplift from planning permission goes to the public sector again, and that would be self-financing, would also help a huge amount of infrastructure investment. The other thing about government is that government's investment has to focus on high multiplier investments, and of course that's linked to high productivity investments, and there has to be conditionality when they're supporting firms, which has been very lax in the past. All of that is difficult, but it also means you need to have investments which are actually only going to yield results over a long period. That's fine if you have a proper, if you like, signaling that the expansion today is going to be adjusted down again in the future, and that's credible as far as markets concerned. In terms of, therefore, investors, how do investors see all this? The first thing is they need to be really aware of these big macro trends, because that's going to overwhelm all their stock picking potentially. And it's not good enough to say, oh, I don't do the macro, I'm just going to focus on the bottom up. That is, you have to, in the West in particular, in other words, in the countries which have done lockdown, which have high levels of indebtedness, in emerging markets where, apart from China, which by the way has a 50% savings rate, so it's hardly relevant, they have much lower levels of indebtedness, and it's much more sustainable, and then they're much more likely to have V-shaped recoveries. And you have a situation in the West where these macroeconomic scenarios are hugely important, because there's been so much volume of money following in a very, very homogenous way the same sort of investments. And of course, particularly this is relevant for government bonds. We have also there are a lot of things which have, if you like, been speeded up by the crisis. One of them is how we get out of QE and what is the point of QE and what we're trying to do with it. QE initially was a means to stop banks falling over and therefore avert the depression. But to say that would have maybe caused investors to realize how bad it really was, and so caused the depression. So it was sold as some way to sort of stimulate the economy. But that was never the fact or even the intention. The intention was actually to make banks able to have a steep yield curve. This is implicit in the design of the initial interventions, and to allow them to access capital markets and recapitalize. In the US, of course, they've done that very effectively. They have recapitalized. In the UK, they've done it a bit. In Europe, it's really been lamentable, and there's therefore much more vulnerable. But what we have is a vulnerability still to a bond crash. We've got a vulnerability to that demand not coming back. So we need to really have as investors, we need to focus on what policy is looking like, but also if you like, the warning signals that international central banks, international investors and central banks in particular are changing their behavior. So changed behavior by a lot of institutional investors may be a function of financial repression. Financial repression, for those who are not familiar with the term, is defined as any policy which captures domestic savings in order to fund the government, and to do so at a lower cost than they would otherwise have to face, which in English means robbing savers. That's what financial repression does. It basically tells a pension fund, you only can invest in AAA bonds. Oh, and by the way, we've got this rating agency, and the only thing they're allowed to call AAA is our bonds here that we've just issued. It's that, in a very glib way. It's that sort of thing. You're forcing. So whereas in the 70s we had capital controls, people weren't allowed to take money out of the country. We have the same thing, only we don't call them that. We call them macroprudential regulations these days, because to call them capital controls, brings up nasty memories. But the pattern of trying to restrict domestic capital to only invest in domestic assets is going to come, and it's going to that's going to affect, I think, how we think about currency movements and what the global imbalances are going to do. Particularly important in all of this, of course, is reserve currency status and who's buying US treasuries and all the rest of it. In the last month, we've had a record outflow of central bank money from US treasuries. Having said that, I'm not worried yet. Why? Because China's not a seller. The sellers have been those who are simply not being given swap lines, and therefore just need the liquidity. And so, hopefully that is reversible. Not least, I mean, when we had 10 years ago, when we had quite 10 years ago, when we had the initial swap lines extended to emerging markets, I was talking to the Fed at that point, and I was making it pretty clear, we're not doing it. They shouldn't be doing it just for their purposes. Just for out of the goodness of their heart. It's important for the Fed that they keep people focused on the benefit of holding treasuries. And so there is a need to look at the pattern of holdings in US Treasuries also in order to get a view of where currencies are going, particularly the dollar.